What are the different types of tax-deductible savings accounts? The most popular forms of tax-deductible savings accounts are the IRA and the Roth IRA. These work in different ways, with the tax deduction applying to contributions in the former case and withdrawals in the latter case. There is also a special savings plan for higher education expenses that offers a variety of tax benefits. One popular form of tax-deductible savings account is the IRA or individual retirement account. In the original form known as a traditional IRA, contributions are tax-deductible. This means that a person earning $40,000 US who pays $2,000 US into an IRA will pay income tax for the year as if he earned $38,000 US. The person does not pay tax on the fund until he retires and begins making withdrawals. This money is then classed as part of his income for the year and is subject to income tax. The contrasting type of tax-deductible savings is known as the Roth IRA, named after the politician who sponsored the legislation setting it up. It reverses the tax process, meaning the contributions to the fund are not tax-deductible but the withdrawals upon retirement are. This would normally be an advantage to somebody who is in a higher tax bracket upon making the withdrawals than when making the contributions. Another major difference between the two types of IRA is age restrictions. With a traditional IRA, there is a 10% penalty for withdrawing any money from the fund before the age of 59.5, save for some exceptions related to education, health, or home purchases expenses. A traditional IRA holder must also begin to withdraw some money from the fund upon turning 70.5 and must make a minimum withdrawal from the fund each year after that based on a sliding scale formula. While there are still withdrawal restrictions on the Roth IRA, in certain situations they are less stringent than those associated with a traditional IRA. This can be a benefit if, for example, the person is not in need of the income at the age of 70.5 and would rather the money be given a longer chance to grow tax-free. Parents wanting to save money to help fund their child's university education can use a tax-deductible savings account known as a 529 plan, named after the relevant section of US tax law. Such plans have significant tax advantages. The person paying into the plan can deduct the payments from his taxable income for the year. The growth on the money in the plan from investments is not taxed, and the student usually does not pay tax upon receiving the money as long as it is spent on approved college-related costs such as tuition fees, accommodation, or equipment.